Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, November 11th, 2022, Veterans Day.
Thank you all, veterans.
Yeah, exactly. Thank you to all who have served so that we can live free. No greater love is sacrificing one's life for another. You've sacrificed time, whether that's with family, whether that's vocation, so that we can live in freedom and do what we get to do. And so for that, we appreciate you. Thank you for that. S&P 500 currently sitting at 3982. I'm David Zarling. I'm here with Ian, Chick-fil-A Cheerios, McMillan. This is a big week. This week could go down as a significant signpost or mile marker in markets. When I say markets, it can be anything from equities, bonds, commodities,
Currencies,
and crypto.
but yeah, as we say, the fiat and the digital kind.
Where do we start?
So I think we've got to start with cryptos and Bitcoin. So from a technical perspective, a big level broken in Bitcoin this week.
Let's do that.
We knew nothing about the news and what was going on.
Let's do the exercise.
Big headlines. And you pulled up a chart of Bitcoin priced in US dollars and zoomed out to a weekly, and you saw that break below the late 2017 highs, an area that's, we've consolidated above this for like 5 or 6 months. And so to see it break with, pretty strong conviction and volume, it's not a great looking chart. It continues to act very bearish. Cryptos had bottomed back in like May, maybe. Bitcoin had.
Well, yeah, I was going to say
hadn't really put in June, like mid-June-ish. Still one of the weaker, assets from a technical perspective through all summer and fall. Yeah, and to see it break the 19,000 level.
Well, we had talked about, right, the 18,400 to 18,600 level on Bitcoin was a huge level.
Mm-hmm.
Going back to, like you said, late May, early June. And that broke this week. And again, we're not even talking about the noise yet. What we've seen is weakness across cryptosphere. It's not just Bitcoin, right? We've seen Solana give up almost 62%. When we look at Ethereum, also had a breakdown.
Below
now
its 2017 highs.
Still above, trying to reclaim a level that's been going back to September.
Like that 1240.
Yeah. Bitcoin's broken down a lot of, for lack of a better way to, I'm not going to use the maybe actually official term, but some of the crap coins really took a hit this week. And the noise surrounding this, FTX.
Nuts. And I think most people knew, right? The red flags have been there. The 18% APR staking, things like that you knew as an adult with common sense. How are they giving out double-digit interest rates?
Yeah, when the risk-free rate is like less than 1%, how are you getting 18? That's absolutely fair. And
this all fell apart.
And I want to be careful with the hyperbole because we don't know what we don't know at this point. There's always a fog in markets. And that makes some people uncomfortable. It actually makes me excited. And in this instance, I should be careful. I don't mean excited because there's real people that got really hurt by this. But when you have an exchange, a crypto exchange like FTX, and for those, there may be clients listening to this who are like, what are we talking about here? So FTX was an exchange, one of the largest, not the largest, but one of the largest exchanges for trading crypto in existence. And within a matter of 24 to 48 hours, it went from viable to not viable.
And certainly, I would say the exchange that invested the most in marketing.
Correct. Clients
Like-
would recognize it from the World Series. It was on the umpires'
Bowl.
jerseys.
Yeah.
Super Bowl commercials, the Heat Arena.
Naming rights. They were at the forefront.
Tom Brady was doing commercials.
We're going to be out there. We're going to be in your face with our marketing. We are the new exchange. We're the biggest. We're the best.
And so
And certainly, as an outside, like I did not have an account on that exchange. Not a big into crypto trading a ton. We saw things like Celsius and Voyager, other platforms that had fallen this year. But
right, there's been other associated platforms or technologies
I think that FTX would. I'm not surprised.
Yeah, now that we know the details, right? There's a little bit of hindsight bias. We know some of the details now as far as they were issuing their own token, how it was associated with different entities, how it was pumped. And again, we're going to get more information as this comes out. They just filed for Chapter 11 for FTX. So think about that. A firm that sponsors the Heat Arena, a firm that was on every umpire jersey or shirt, multiple superstar sports sponsorships. It was a place where many individuals held their crypto and traded their crypto. And we don't know the ramifications of this. Like, there's still going to be shoes that drop out of this. And what I mean is just, there's people who invested 100% in crypto. Yeah. Not our clients, but there's people who were involved in this. And it's the hard part of markets. They can't get that money. And some estimates are, this is $10 billion worth of money that is gone. 10 billion is a big number. It's a number that many people can't grasp. And when we look at organizations from the past, right, we had LCTM, 1998, Asian currency crisis.
Long term, yeah.
Right? Bunch of Nobel laureates, Black-Scholes model, crushed by high leverage with a huge win rate, high leverage. It's about fat tails. Markets are about fat tails. You have Enron accounting scandal in the early 2000s. You've got Lehman Brothers, 2008. And if the dollar amount is correct, we're talking about 3x, 3 times Lehman in the crypto sphere. I have no idea how this would potentially play out connected to equities. It may have zero impact. But from a crypto standpoint, this is a Lehman-like, Enron-like event. If you just keep it in that framework, within crypto, this is a huge, huge event. And we don't know the fallout. And here we have Ian start out appropriately. If you take all of what I just said and had amnesia, forgot everything, the fact is something like Bitcoin is below a very important level, 18,400, and that's a problem. Because who knows, maybe that marks a bottom. Maybe all this shenanigans marks a bottom. I'm open to that.
Could. We've been in a drawdown for how
long? Since November of 21. Yeah. So basically a full year.
Exactly a full year to...
Bitcoin's down 74%. Ethereum from November of last year to November of this year is down 73%.
It topped on my birthday last year. That'd be funny if it bottomed on
birthday boy.
Birthday this year.
Yeah. And markets do move in cycles. One crypto asset, cryptocurrency that has really paid a price is something like Solana, down 94% from that November high. So there's plenty of carnage going on within crypto. Whether that spills over into equity markets, we don't know. But simultaneously to all that noise and Bitcoin, a major market player, breaking an important level to the downside, we saw equities.
Yeah, stocks had a good week, so far. Now, majority of that in the last 2 days.
I was just going to say the majority of it within 1 hour of Thursday's open.
Of pre-market action on Thursday. Yeah.
Yeah. So you went from a market on close of Wednesday the 9th to a +5 move, +5% in something like the NASDAQ 100 from that close to the open. So cash markets aren't even open yet. It's through a futures market, a gap up of 5%. And there's a lot of debate about that gap up, or as far as like one of the best days. There's a lot of debate as far as, is this bear market rally?
Oh, yeah.
Or is this a price thrust, the start of a new bull market? Controversy.
There's so many still, I would say for the third or fourth week in a row, mixed signals. I know that sounds super lame and cliche, but so, I mean, bottom line, indices move higher, likely going to see their third. I can't remember. I know we had the back-to-back, Friday buying was a big topic there for a few weeks. I can't remember what happened last week.
Last Friday there was buying. The Friday before that there was buying.
Okay.
And then it was basically the last low that we've seen, ironically, was on a Thursday. It wasn't a Friday.
So the risk on behavior short term continues. The Dow's been above its 200-day. I think the Russell got there today. We'll see if it closes there. Not the prettiest daily candle. So now you got 2 out of 4 of the major indices above their 200-day. Other areas, though, semiconductors, not quite convinced. Tech, a lot of these.
Let's paint this picture from a big picture perspective, right? Because we're in the trend identification business. We're in the risk management business. So when we look at, and if you allow me, we'll use something like the S&P 500.
I'll allow it.
Okay, all right. I appreciate that. Right, we know we've been in a correction since the beginning of the year using the S&P. Now, we know underneath the surface, we've been in a correction since February of 2021 when we look at a lot of stocks.
Yes.
But using the S&P 500 since January of this year, we have recorded lower highs and lower lows. An example of this would be, for example, the high back in January, and I'm going to try to use round numbers. I'm not going to get exact with this because people's eyes roll in the back of their head and their brains can't, right? If I gave you like 3 phone numbers in a row, there's no way you would memorize that.
I was hoping you were getting out to 2 decimal spots.
Okay. And I appreciate that. But right, we got S&P 500 at 4,800 in January.
Okay.
We then go and correct into March to 4,100. Again, I'm rounding.
Okay.
We then record a lower high at 4,600. So we start the year at 48, lower high at 4,600. We get a nice rally from a low in June that's around 3,600 all the way back up to 4,300. So start of the year, 48.
46.
March, 46.
43.
43.
Okay.
We currently sit at 39. 3,900, getting close to 4,000.
I think you had mentioned this, but lower lows.
Yes, all of them recording lower lows, right? So, for example, in March, around 4,200. In May, 3,900. In June, 3,600. In October, 3,500. So if we just use price,
Since a pattern.
it sets a pattern. It sets a sequence of lower highs and lower lows. That's one way to identify trend. So on the year, we are currently sitting in what we would call an intermediate term, because time frame is important. Intermediate term would be weeks to months. Time frame, we are in a downtrend.
Yes.
That is factual. There is no debate, theory, mincing words. From that time frame, we're in a downtrend. Another way to define that would be the past 200 days of information averaged. So we have something at 200-day moving average falling. Now, if we were to talk about the near term, days to weeks, we have an uptrend. So big picture, downtrend, near term, uptrend. And I think that's the picture we want to paint, because that's exactly what Ian's describing when we say mixed signals. A counter trend, a move up in a primary downtrend, is a counter trend. We won't know until the future if this is a sustained bottom that just took place in October. Could be not.
When you look around, I mean, we still, like a day like today, and some of the failed moves we've had in important stocks, example, UNH.
Yeah, I was going to say, describe important stocks, why they're important.
I'm going to be honest, like UNH broke to new highs, pretty bullish.
And why is United Healthcare important?
Because it's the largest component of the Dow.
Of the Dow, okay.
And now that's failed, and it is failing in spectacular form. So is that risk off? Is that now market participants they want to dump all of this low beta blue chip Dow large cap value type stuff that they were in, staples, utilities, defensive names, McDonald's, and we're ready to get risk on? Or is the Dow now, the index that would lead us on this last rally, and has really led all year, is it going to fall apart? Don't know.
And I love that. You want to know why I love that? Is because you have lots of prognosticators out there who are one of two camps. This is either 100% a bear market rally, or 100% this is a price thrust that's leading us into a bull market. The fact is, no one knows except the Lord Almighty. Like, there's no way to know what this is other than weighing.
The adamancy that people can't, like, okay, we're Q3 2017 and you want to be adamant about stocks going up. Okay. But you want to be adamant about anything happening in this market environment in 2022? Like, that's silly. And I think that's really egotistical
And irresponsible.
And I see it from both sides. Comments of like, people think this is the bottom. That's so comical. Or just the absolute like adamancy, again, to use that word that people use towards, I can't believe, like, if you're not buying stocks here, you're an idiot. Like, that kind of attitude. And
because it's definitely, to your point, it's a mix. Like you said, 2017, lots of evidence, like to the T, that the market's moving higher. And here you have a situation of an intermediate term, previously defined, weeks to month downtrend. Near term, days to weeks uptrend. By definition, a counter trend. Is that a bottom? It could be.
We're likely going to have, now we've got time. Yes, we got time. We could get to 40. We could get to 4,300 by the end of the year.
Oh, yeah, for sure. We get to 4,300 by the end of the year.
We have now had 11 and a half months of a downtrend. I'm sorry. It is such a turnoff to me when I see other people. Some of them mainly comes from the sell side. If I'm being honest, a lot of this comes from sell side or just like random people on Twitter. If it turns into the next leg higher, totally get it.
Great.
I don't need to be the person on Twitter that is constantly pounding the table that like, I know what's going to happen over the next 6 to 12 months.
You know what, Ian? That's funny you say that, because there was a meal once with my family where I did pound the table. And you know what that resulted in? Me apologizing later.
Yeah.
So like, how about we don't pound the table? How about we work in theses? For example, if this is a bottom or the bottom, the S&P 500 would stay above 39.15. We would see the leadership out of this hole continue to lead. And that's the interesting part about the dynamic this week is I tend to tilt towards an individual like Minervini or Thornton who would say, hey, out of this, you would want to continue to see the leaderships lead. And what I mean by that is like the example you gave of UNH or of United Healthcare being rotated out of hard today, maybe the last 2 days, things like Eli Lilly, Enphase. There's other things that were leading to the upside. This leadership out of this hole has been, at least this week, from the crap, meaning big cap tech, Meta.
And maybe that's where we go back to.
And it could be the full rotation.
It could be. Maybe we get now structurally a lot of these, I don't think ARC's everything in 98 was still in an uptrend. They got hit hard, but
I think XLK tech ETF versus S&P is an important chart. It held an important horizontal level. It's rallying. It's back into a range. You could see it move much higher, even into spring of last year. So you're correct. Maybe we see tech lead from here and value pause or digest or fail, which would be interesting for a Q4, because that would be different than many Q4s where you typically see the leaders of the year lead strong in the final part of the year. So if we see this shift that's towards tech and growth going into the final part of the year, it truly would throw most for a loop.
Yeah, because that's when you start getting your people throwing in the towel, probably some window dressing, a phenomenon I used to not believe in. But now I do, because I do believe that many advisors and portfolio managers are just that lame, that they would simply, that would be their approach for statements to look pretty. I used to think that no one was that ridiculous. Absolutely believe it now.
Oh, yeah, for sure. So out of this week, what's interesting...
Isn't that kind of a momentum strategy?
Oh, it is. Momentum's real. It's in all aspects of life.
Just buying whatever the best stocks over the last quarter was and putting them so they show up on the quarterly statement. That's kind of a mental momentum strategy they're probably not even aware of.
And where I'm going with this current week, right? Because, and admittedly, I want to be like full disclosure. This week will be one of the, on a relative basis, one of the more weaker performance weeks for our clients. And it's because we're not owning things in a downtrend, meaning we're not sitting there and owning something like Facebook that's down from its high 70%. We're just not doing that for our clients. Now, the interesting thing is Facebook has had a plus 25% week. And so should we own that? No, because when you look at the information at hand from a broad perspective, meaning weeks to months, it's in a downtrend. So just to get back to a 70% drawdown, it had to rally 20% this week. And that's what we're seeing from a lot of these big tech names, like Google rallied 11% this week. Are you buying that? Are you buying Google? That would be, Ian, if I went and bought Google for my clients, you should fly over here, grab me out of my office, and throw me in the Milwaukee River.
And maybe but right here, right now, again, it's a lower low.
It's a downtrend.
It's a massive downtrend. Actually, that has been picking up steam. Leg lower has kind of been more dramatic than the last one and quicker.
Right. Maybe we see a return to tech and growth. That's a possibility. I'm open to that. But what's interesting about this week, right? Because the day yesterday where you saw a 5% gap between the Wednesday close and the Thursday open, and then subsequently moving higher throughout the day, that's not something we've seen frequently. That's like March 2020 behavior. It's also behavior that's existed the majority of the time, I'm not saying all the time, in bear markets. Now, we've also seen it happen at the start of bull markets. And I'm open to that, totally open to that. But to declare that this is the start of a bull or that this is a bear market rally, either of those, if you're declaring either of those scenarios as a certainty, is irresponsible. You have to operate in thesis, meaning S&P 500 above an important level that we've identified previously of 3,900, that is a great characteristic. We can take on risk in that environment, understanding that you're still below a declining 200-day, you're still in a sequence of lower highs and lower lows.
To your point, Wesley Maddox, also a fellow Charlottonian with his father just down the street, great technicians, great portfolio managers. He had some good stats on these types of rallies. And yesterday I pointed out that in the 2000 to 2002 drawdown, the NASDAQ had 14 days. It was up 6% or more. And
14? Wait, hold
14.
on. So from the dot-com bust, 2000 to 2002, 3?
Yeah, like October 02, I think was the bottom-ish.
And so 14?
14 days. They weren't all gaps, but 6% green days or better. If you had bought stocks following those, you would have been wrong every single time.
So 14 times where you had an experience like Thursday of this week.
Yeah.
And
basically over a 2.5 year period.
Went on to make lower lows.
Went over to make lower lows.
I mean,
and it goes back to what's one of your biggest things you harp on: best days surrounded by worst days.
Right. They're married. They're at the hip. There's no doubt about it.
I think you had a slide on that in Lunch and Learn.
Yeah. Lunch and Learn, board meetings, whatever. We'll talk about it because it's not like the best days happen in a silo. And that's a famous fallacy is, oh, you can't be out of the market because you missed the best days. Well, that's a fallacy because you can't just take that in a vacuum. You got to.
Yeah. A lot of the best days are just
surrounded by the worst days.
Yeah. They're just recapturing, the 5% up day is kind of offsets the 5% down day from 2 days ago.
Right. And so it's going back to your original statement about like you feel bad about saying mixed signals. It definitely is because you have a near-term uptrend, a daily time frame versus a intermediate term downtrend. There's no mincing words on that. And the interesting thing about this week is just that it came from the crappiest. The price thrust to the upside this week came from the things that were beaten down the most. And so there's a little bit of pause there because typically you'd like to see a regeneration of the bull market come from the leaders that had been leading, that had been strong during this weak market. I don't know.
What do you think has been one of the bigger catalysts? I have a couple ideas other than more buyers and sellers. What do you think has been one of the bigger catalysts towards the excitement we've seen in equities the last 24 hours?
So when you say catalyst, do you mean mechanically or do you mean like news or do you mean
anything happened from like on a chart? Any other assets? Any other?
I just think from a short seller is nothing but a potential future buyer. And so if people got tilted on the wrong side of the boat and were too short one direction, right? Because, and I don't mean the boy band, I just mean from year to date, when we look at what's the weakest, it was the FANG names, it's software, it's ARC. Those were the things that are the weakest. If people got too short there and they have to close that out, they become buyers. And so that's where my curiosity is raised because this rally we saw this week, while I acknowledge it and it's important and we have increased exposure because of it, it's come from these crap names, like things that are down the worst.
Things that are in 75, 80, 90% drawdowns.
And so for me, where did this come from? Besides, like you said, the supply demand dynamics, is this just short covering? Because I would like to see the leaders continue to lead. I would like to see the UNHs, the United Healthcares, the Eli Lillys, the Enphases, the Tractor Supplies, the things that have held up better continue to lead. And that's not really what we saw this week. And so I have a little bit of pause there because are we out of the woods? No, from an intermediate term standpoint, but you got to come from somewhere. Like a bottom has to come from somewhere. And as long as we're above 3,900 on the S&P 500, that's definitely a strong possibility. But I will forewarn people, the faster you move to the 200-day moving average, there's some risk there. The faster you move, the more you look like a counter trend rally. The faster you move, the more you look like a bear market rally. How about you? What do you think?
I think people are excited about the dollar.
Oh, the dollar.
Dollar breaking some rates of trend. I wouldn't say it's broken. So there's kind of two rates of trend that I've been following. You've got one from the May 21 lows, one from February of this year, which that's kind of the trend got a little bit more dramatic. I would say the year-to-date trend, mid-January, early mid-February, those lows kind of from like the 94 area. If we're looking at Dixie, DXY, obviously that range trend. Also, we broke 108, that horizontal level, which short to intermediate term, not the best look. Still definitely an uptrend, still above an upward sloping 200-day, still above 104, which is a huge level. But definitely something that I feel like has been one of the things that a lot of participants have used as and it's a valid, right? Because it was, the whole way down, the dollar is too strong, So now we get, a pretty bad week overall for the dollar. I mean, this is I
might have to change my profile pic.
It's followed through from last week's long upper shadow.
Yep.
And so I think that gives people like a lot of, maybe just kind of wiping their brow and saying, okay, maybe this headwind is out of the way. And it's been a big one.
What intrigues me today, Friday, 11/11, is you've had 2 days of a trade-weighted dollar getting hammered pretty hard. The mantra had been, we just need the dollar to cool off and equities will rise. And that was true yesterday. And maybe we're going to see that follow through today. But the 200-day moving average, a very rising 200-day moving average for a trade-weighted dollar, is only 1.5% away, along with some very important horizontal resistance. And then you think the flip side on equities, there's 200-day moving averages moving that are right here within a day or two reach. So the dollar is going to reach this pivot point. Equities are going to reach a pivot point. Now what? That is going to be the tell, in my personal opinion, and really my opinion doesn't matter. A thesis would be, if we're going to have a meetup on important horizontal levels and a 200-day moving average, both on an equity basis and a trade-weighted dollar basis, that's going to be important information how we come out of that.
I could see that. You have a strong Monday and Tuesday. We get there.
Right.
And then you've got like two guys standing in the middle of the street. Just pistols for a duel.
Just looking at each other. One's Michael J. Fox with some type of iron on his chest. Okay, so we get to the 200-day on S&P, which is currently sitting at about like 40.80. Coincidentally not. 40.80 is a huge level horizontally.
Look at that gap there from September 13th.
Right. And a volume profile basis, which Dan Gorkuber's
Dan's great at that, yeah.
Fantastic. So we've got this level at 40.80. You've got the S&P 500's 200-day falling moving average at that level. You've got DXY, the Dixie trade-weighted dollar, approaching its rising 200-day. Like you said, why would it not be something next week that we're looking at and saying, how does this duel resolve? And it's really hard to fight against trend. Why would we fight against trends? Some people say don't fight against the Fed. I say let's not fight against trends. And so it's going to be really interesting to see how this plays out in the coming weeks, because we're definitely not out of the woods. At the same time, if you were to see a bottom take place, some characteristics are being fulfilled. For me personally, I'm struggling a little bit with that. It's the weakest that are doing this week. It's the things that have fallen the most that are carrying us higher the most this week, rather than the leadership that has been great this year to date that are doing it this week. That's where a little bit of like, I've got a little bit of a question. And maybe that's just a speed bump. Maybe that means nothing 6 months from now when we're reaching 4,600, 4,800 on the S&P 500. And we're in an environment where, and we've talked about this in the past, Ian, in previous corrections, when we study them, it's not the point of the correction where everybody knows it's a correction and are net short that's dangerous. It's when you're in the point of the correction where the shorts have been cleared out that becomes dangerous.
Yeah, certainly some clearing out.
I was going to say, like, if you're net short still today, that's a problem. And so did the last few weeks, 3 weeks, if that cleared out the short supply, meaning future buyers, did those people have to cover? If we roll over from this point and those people are risk adverse from taking on additional shorts, things might get ugly.
Worn out.
Things might get ugly quick. And this is that game planning, right? I'm not here to say this is a bottom or the bottom. I'm not here to say this is a bear market rally. I'm just here to say you have to have a plan. And that's part of the adaptive process is, okay, we've said consistently above 3667, above 3674, we're going to have some exposure. Below 3,800, we're going to be light, which we were this week. Going into this week, we were very light.
You look at it, and I think that's such a great point to make, Dave. Okay, so like a big level for us was 3,900, a little bit shorter term, this 3,800, this base, if we want to call it that. I mean, you look at the Wednesday's candle, and not just on the major indices, but on a lot of individual stocks and ETFs. Abysmal, absolutely abysmal. I can only go into Thursday morning with the information I have Wednesday evening.
That's correct.
And yeah, they popped it and they run it and you cover and right, because you're wrong.
You don't know you're on the wrong side of the trade until the level that you pre-identified has been breached. And that happened with us this week. There's going to be underperformance from a asset management perspective, but not irresponsibly so, because below 3,800, we're going to have light exposure. That's just, you're in a downtrend, broadly speaking. Yes, we have individual stock exposure. Yes, we have that.
Oh, yeah. Still, individual stocks working great.
But not until Thursday do you say, oh, okay, the information has changed. We now are in an environment of it's mixed signals. We could have a bottom on our hands. We're still within a intermediate term downtrend. So you increase exposure. And so we'll see what happens from this point forward. But above 3,900, our clients know they see an increased exposure, and that will continue to happen as long as we're above that, fully well understanding the dynamic that we're still in a months to weeks downtrend. And until we clear the lower highs that date back to the beginning of the year, let's say for some crazy reason we were to reach that on Monday, that would be about 41.45. That's the least likely scenario, probably approaching that from a different angle. That's about 41.20. That would be above a 200-day moving average. But we seem to have a meetup scheduled with the 200-day moving average on something like the S&P 500. And this is a Bayesian approach. As the data comes in, we make adjustments. Above 3,900 is a good start. Is that a fair picture painting?
I think it's a very fair statement. Short term, you're above these October highs. Again, the woods we have not left, but we might 100%. Be close to the tree line. We might be close to the tree line.
Yeah. Open to it. Absolutely open to it. The only problem I have is there seems to be a nefarious character leading us out of the woods, which is big cap tech. In any other environment, I would have been totally fine with, because big cap tech got us here, meaning from a big picture perspective, like months to years perspective. That was what was the leader. And that's what's been weak this year. And that's what's been the strongest this week. So we'll see. We'll see if big cap tech's going to get us out of here. I haven't given a lot of time for us to do this, Ian, as far as like the final few minutes here, because we're bumping up. We didn't talk about credit and rates. We didn't talk about commodities. anything you want to touch base on there before I force us to wrap it up and head on to our day jobs?
So I guess going back on to that, the dollar weakness has, of course, spurned a lot of excitement around precious metals and other metals, but precious metals for sure. So gold miners, silver miners, definitely seen some bidding this week. Oil, still below 95. Yeah, we're holding here at 84. Crude's it's been pretty range bound for a month or so. Yeah, other than that, I can't think of much that comes to my mind in the commodities space.
Maybe sugar.
So I think sugar, you had mentioned sugar.
Oh, no, man, that's all props to you. You brought that up earlier this week. Sugar.
Yeah, breaking down a little base.
Definitely showing some sweetness. We'll see if that carries through. It is interesting from a trade weighted dollar perspective how some of these things are operating. As Ian said, we're not out of the woods yet. This is a start. There's never going to be an environment where you check all the boxes. I don't think this is an environment from an evidence standpoint where you get like super crazy long.
No.
Same as an environment that we were just in where you don't get super crazy short. We got to wait for the rate of trend to change. And I'm excited for that. And maybe, I don't know, Ian, maybe that rate of trend doesn't change for months. Or by 2023, we're talking about 4,800 on the S&P 500. I don't know. And that's an important thing to say, because we don't know. There's no way to say emphatically 100% this is a bear market rally or 100% this is a bottom and the start of a new bull market. When you look underneath the surface and you look at all the data, like you said, Ian, it's mixed signals. And we're actually going to have to come up with a different podcast title because we've used that in the past. We'll come up with something, but it is not an all clear, but it's also not everything is dire.
Yeah. Things continue to save themselves. We certainly have not reached there's stocks that continue to move to new highs. It's hard for me to believe we've reached any type of capitulation. And maybe we don't have a capitulation. Maybe we've had a capitulation out of enough of these things, or their drawdowns were bad enough that I don't know. I have no idea.
And the hard part of if this is a bear market rally, you could have something like the Qs rally 10% and not fix anything.
Which we saw many times in the dot-com level.
Exactly. And so process, risk management, adapt or die, these are the ethos we have to embrace, because you cannot sit there and say you know what's going to happen next, because you don't. Because 1 month you can have a billionaire listed on the cover, and the next month you can have them declaring Chapter 11 bankruptcy. And that is a pretty good wrap up from start to finish of this podcast. Anything else for you, Ian, before we close out?
Nothing. Materials, industrials, these types of areas continue
good point.
Financials continue to lead. I know we just got to talk about, well, you said tech had the best last 2 days. Talking about significant trends here. These stocks, I would say overall, continue to have pretty good week in general. Exactly.
So we take it week by week. We're Bayesian. Underperformance this week for our clients. Perfectly normal for a scenario where you're in a downtrend and you have this rapid price movement. We're not going to be 100% long into a low. Just not how it's going to work. Just same thing. We're not going to be 100% short going into a high. Ian, I appreciate you. Happy birthday to you.
Did you know that when I did my ancestry.com, it came back I was a third Bayesian? It's true. My whole lineage.
You don't even know how bad. I just want to cut the podcast here. Like I don't even want to say anything. Like,
Ian, dude, apparently it's been in my blood for generations.
It's fantastic. Someday we will go revisit the Bayesian motherland and we'll have a good time hanging out with family there. But Ian, I appreciate you and everybody on the Adaptive team and at Client First. Happy birthday to you and Ian. Again,
Thank
to all our veterans, amazing that you guys would give what you gave. But Ian, you deserve a nice weekend celebrating your birthday. Everybody, thank you. Give us a high ranking. Share it. We appreciate it.
Have a great weekend, everyone.